I'm Michael Fox, and this is the Prospector News Podcast. And joining me is longtime contributor and publisher of the National Investor, Chris Temple. Welcome back, Chris.
Good afternoon.
Good afternoon. Well, we had another Fed meeting and another quarter point rate hike. Jobs numbers came out today, and considering they were expecting to be dropping those, they were up. So that was a surprise. What's your take on everything? Markets were down, then they were up. As it's mayhem out there, Chris.
Well, somewhat. Look, the markets are still trying to grapple with assigning odds to two different scenarios. They're looking for some kind of a binary outcome. Number one is the Fed is still in tightening mode, and number two is the Fed has found a reason to start easing. Markets are still, as of this week, now that we're at the 5 to 5.25% level for the federal funds rate that the Fed promised us, in the last few months, they're believing that we're going to get at least a couple of givebacks before 2023 is over, that the Fed will be cutting rates 50 basis points before the end of the year. So that's the outcome that 1 minute they're trying to price that in, the next minute they're not. What the market, in my opinion, and I've said this before, what they're not accounting for is a third scenario where the Fed is maybe neither tightening anymore, except for quantitative tightening and selling their balance sheet continuing, nor are they easing, but they're going to keep interest rates at this level for some time to come. And, that is going to result in a slow, dull ache over many months for corporate profits, for the economy, for the markets, et cetera. So that's a scenario that, all else being equal, we are going to have. The Fed has promised this multiple times, and we can fault them for an awful lot of things, but one of them is not in not being forthright as far as their plans are concerned. So I still am one who does not believe that the markets have properly priced in the world that we're heading toward and the world that the Fed has promised us. And we certainly saw that at the end of the week, where, 1 minute you would think that despite the strong jobs number that we had, and at least for the week ending period here, that the bank's situation is less bad, at least it's off the boil. You would have thought that this jobs number might have caused markets to sell off a bit. Well, it did result in some changes. The dollar rallied, gold was down after tickling its all-time high, but the equity markets behave as if it's all systems go. So we'll see what happens, but I'm still one who is of the view that from this point through probably the end of the summer, the bias is going to be down for a lot of these risk assets that have rallied.
Yeah, I think that's the case. We're here. It's May the 5th. Happy Cinco de Mayo to you. And I gotta say, I think we're going to see a pretty substantial sell in May go away this year, because I don't think people are going to want to be holding any of these risk assets over the summer months when the volumes are lower and stocks can take some pretty mighty swings to the up and down sides.
Well, that's true. And, you look at that numbers that came out today, and granted, there was, I think, 110,000 jobs trimmed from the last two reports cumulatively that were not as good as what was first said. But, the numbers got that right back, with this last month being much stronger than expected. More so, the unemployment rate stayed at 3.4%. And astonishingly, to some, this was as something like 800 and some thousand people were added to the job pool. So the participation rate went up a fair bit. The message being that there's still lots of new jobs out there. They're being filled. and last but not least, they're being filled at higher prices or higher costs to business, because also unexpected was that the wage growth was significantly more than what had been thought. It had been ratcheting down some, but this last month was up 0.5%. It was up 4.4% year over year now. And sure, that still does not keep up for the Joe Sixpack and Sally Soccer Mom with the cost of living, which has been more than that in the last year. But it does add to this overall mix where the world in which we live shouldn't be this way, but it is. The Hobson's choice we have is that if we want to see the Fed succeed in vanquishing inflation, then we must have slower growth or a recession, and we must see the job market weaken considerably. So it went completely the other way this time around, and it led to some people after this morning's numbers, not without foundation, suggesting that this pretty much guaranteed the Fed may not be done. That they always are reminding us repeatedly that their two mandates from Congress are stable prices and a strong labor market. Well, if you believe the numbers, we've got still a strong labor market in spades. So they can put a few dents in that to get the other part of their mandate in order, and that is stable prices, which we still do not have. So yeah, I mean, it's not going to shock me, especially if we got a successive good jobs number the beginning of June. Yeah, they'll go another quarter or 50 basis points before they peak. That's still in the realm of possibility, and the markets don't believe that.
Yeah, the market reaction seems to think that the Fed's done and they're going to start to taper again. But I'm in your camp. I look at those strong job markets, and I've said all along, as this tightening environment began, as long as the jobs market stay up, the Fed's going to continue to raise rates, and we're not seeing a diminishment of the jobs, so the rate increases are going to continue. So I'm of the belief there's at least another quarter point coming in the next Fed meeting. Now that's, I guess, subject to them actually breaking something in the meantime between now and 6 weeks from now. But whatever that is, I'm even thinking that even if it was a bank crisis, they'd probably let another 2 or 3 go, because they were able to shrug off the last 2 or 3 that went in the last 6 weeks.
Well, that's right. And look, they know that in the end, and I said this during the week this week, that don't forget that the Federal Reserve to some extent is happy with the stresses of the banking system, and with a couple of regional banks going belly up, as long as they're absorbed by others, and the system is still functioning, because over the longer run that will lead to more of a contraction in new credit being issued. It will lead, all else being equal, to less economic growth, and in their mind that means that these bank failures are going to assist them in bringing inflation back down. We'll see how it all plays out for them in the end. It's not going to be as simple as that, but those things will be in that benefit for what the Fed wants. Problem is, it's not getting that same kind of help from other areas, whether it be the jobs number or the cost structure for businesses and commodity prices and things like that. So we'll see what happens, but yeah, I think that the Fed here again, we can fault them for a lot of things, but they've very much stressed that just because a few banks go bust doesn't mean it's going to put them off their game. They believe that getting inflation back in a bottle is a bigger issue than some banks going bust. And of course, that's playing with nitroglycerin. If too many go bust, or you got something seriously breaks, well, then it's going to be a different story. But we're not at that point yet.
No, we're not, but I think they turned the light on the banks again this week, and you saw some of the cockroaches go scurrying for the corners.
Yep.
So they're out of sight, out of mind again, but they're still there. It would not surprise me in the least that we don't see another, 3, maybe 4 banks go broke here before the next Fed meeting. I was reading one report that suggested that there was 4,800 potential banks that were insolvent in the United States.
Yeah, and look, we had in this country at the peak, we had, and I think Powell even mentioned this on Wednesday, 14,000 banking entities in the United States of America. That has over a number of years been cut to 4,000. It'll be cut further. There's no question about that. You and I have talked before about the possibility that the U.S. ends up like Canada with a handful of, nationalized, effectively nationalized banks that are sort of like public utilities almost. And we're going to go that direction, but we'll see. I mean, when Janet Yellen tells us the banking system is healthy, when Jerome Powell tells us the banking system is healthy, when Jim Cramer of CNBC by name says he likes certain banks, what that tells you is that the crisis is not over.
No, that's pretty much, I was going to say, and Jimmy the Greek likes banks, and yeah.
I mean, inverse Kramer has been working gloriously in the recent past, where every time Kramer opens his mouth and says, okay, well, this one went bust, but this bank is still great, run for the hills or short it.
Now, the other question I have with the Fed is, how much further can they go before they start to get political pushback? And the reason I'm asking this question is that you have a government that is bent on pushing the green agenda. So we're all supposed to have electric cars. People are supposed to electrify, they get rid of their gas stoves. If the cost of borrowing keeps going up, and the fact, in the case of electric cars, they're more expensive, it keeps pushing those products further and further away from the hands of the regular American and Canadian to actually be able to afford to buy. And at what point does Fed policy start to get in the way of the green policy?
Well, the Fed policy is getting in the way of everything, not just the green policy. In a different fashion, the Fed is trying to further the green agenda. It's not claiming any influence in this directly. This is more the Treasury Department's doing, but they have build in some incentives for green energy investment and whatnot, disincentives for fossil fuel investment. That's ongoing. And again, more so with the Treasury than the Fed. But you do bring up a valid point. Generally speaking, there has not been major pushback yet politically, because I think, number one, both major parties in Congress, and of course, both of them in the end part of the uniparty that we really do have down here, they come at the Fed from different directions. We regrettably do not have anybody really in Washington anymore who understands how fractional reserve banking works and realizes how and why they need to attack and address the Fed as an institution and move toward its being abolished and having a public system of credit, not one run by this private banking cartel or quasi-private banking cartel. With the Republicans, it's political points. They say it's all the fault of the deficit that we have this inflation and the Fed having to raise interest rates. Of course, Republicans are only worried about deficits when the Democrat is in the White House. Conversely, Democrats think that all the problems of the world would be solved if we only put some women and minorities and maybe a transvestite or two on a board of governors, and then that'll solve the Fed's problems and make things more inclusive. And of course, neither of them is really addressing the fundamental problem. So, I think that we'll get some more serious pushback after the Fed has already done too much damage. Right now, things are still plodding along well enough that you don't have critical mass. And again, mostly because the people in Congress, who are the ones that gave this Frankenstein monster its life, are not singing from the same song sheet because they don't know what the song sheet should be.
Yeah, it's when you're not in harmony, it's definitely a cacophony of sound, isn't it?
It is.
Yeah. So, okay. Well, we're 6 weeks away. Your bet's the same as mine, another quarter point.
I think right now it's a coin toss, and here again, and I've, like anybody that understands what has happened, has been a huge critic of Fire Marshal Jay, as I call him now. We've got first he went from the worst arsonist of all time on monetary policy, creating inflation and all of these imbalances in the markets. Now he's being a firefighter belatedly, and that's not going to end well when it finally does end, I don't believe. But here again, that all notwithstanding, that's water under the bridge for the moment. Looking at what he has to do now, or thinks he has to do now, Powell has made very clear that he does not want to quit early in fighting inflation. The Fed did this back in the 70s. Nixon's Fed chairman, Arthur Burns, let things get out of hand, started to tighten policy. But then we had the recession in 1974. At the same time, Nixon was impeached and we had a new government, or about to be impeached and removed. We had a change in government. We had all kinds of different problems and so forth. And the last but not least, the Arab oil embargo. And that made things worse. The Fed eased policy prematurely and inflation reaccelerated. And then they had to go even more. And over and over and over again, Powell has pointed to that. And again, notwithstanding the blame being with him to begin with to get us in this mess, he has said he does not want to repeat that. And I take him at his word. So for as long as he can get away with it and not break something in the markets too badly, then yes, he's going to keep pushing. He doesn't want to do what the Reserve Bank of Australia just did and pause and then see that price pressures are persisting. That's a tongue twister.
Yeah,
and
no kidding.
then start hiking again. Of all the people to emulate right now, it's that dingbat that runs the European Central Bank, Christine Lagarde, who's even dumber than Powell and Yellen, if that's even possible. And she's when the ECB dialed down their pace of rate hikes, she still said this week that they're not. She came right out and said they're not done. So, Powell, for whatever reasons, I guess it's because what the Fed had predicted, said, okay, we're at the level that we said we were going to get to. Now we're going to reassess things meeting by meeting. But, even though he said, sure, it's a possibility that we keep going or pause, either one, it's going to depend on what happens. And so if you take his most frequently expressed concern and rationale to heart, then yes, unless we see a significant slowdown in the economic numbers, we've got several more inflation reports and economic reports coming out between now and mid-June, when the next meeting, I think the 18th or 20th timeframe, something like that, when they have their next FOMC meeting, then yeah, we will see another one or two rate hikes, because don't forget, and Powell again has said this over and over again. I've said this over and over again. And this is where the market's looking for this binary outcome and assuming that a few weak numbers mean, oh, the Fed's going to soil itself and reverse course. No, they've been telling you for many, many months that this is what they want, to tell them that they're getting to the place where inflation is going to be brought back down. So when these numbers come out that are still mixed as far as the economic stats are concerned, still way too hot in their mind where employment is concerned, still too hot where structural or core inflation and services inflation is concerned, they can say, okay, we're making some progress, but we aren't there because they've told you that they want more of this. You know, they don't often come out and, you know, Powell tried to dance this week around the report from the last beige book that the Federal Reserve's academic staff is predicting a recession. He says, you know, we as the board of governors aren't necessarily saying that, but look, it's a healthy difference of opinion. So that was kind of a squeamish way to get out of that. But the truth is that, yes, they know that in the end, to get to where they want to get, they will cause a recession. They will cause unemployment to move up a fair bit, not to any double digits like it's been at previous peaks, but it'll move up measurably. And then they'll know that they've done enough. And, you know, we're still not there. So we'll see. But again, I think the market, as it has done most of this process, the market is still underestimating just how resolved they are to keep pushing until they do bring the inflation numbers back down more and at the expense of a recession.
Yeah, it's the funny thing about the recession is all these economists, it's like they're trying to not say Beetlejuice too many times for it to appear. You know, it's the reality of the policy is eventually they will push the economy into a recession.
Yeah.
It's the only question is how deep and how long.
Yeah. I'm going to have to get my cartoonist. I'm going to have to think about this now. We got to see some economist or somebody saying Beetlejuice, Beetlejuice, Beetlejuice. You know, they're redoing that movie. I think it's Johnny Depp is going to play the part that Michael Keaton did.
Oh, I did not know that. Well, that ought to be entertaining.
Yeah. That was a funny movie.
Yes, it
but
was.
yeah, you're right. I mean, they look, at some point the light bulb is going to go off more notably over the market's head, which has still not happened. Maybe we need to see more of a slowdown in corporate earnings than we have. It's been relatively modest. I mean, we are in an earnings recession, but even there was so much liquidity front-ended into everything the last couple of years when Powell was in his arsonist mode that, you know, this is probably one of the reasons why the economy and everything isn't slowing down as much. You know, when they created $1 out of $3 ever in existence in, you know, just about 2 years time or so, it's going to take a lot of this to bring that all back in.
Yeah, well, definitely. Now there's two potential events that could occur here in the next 6 weeks, and they could have an effect on the Fed. One is domestic and one is geopolitical. On the domestic front, you have Congress that seems to be at loggerheads over the debt ceiling. Does somebody make a miscalculation and put the U.S. into default? And then what would that mean to the Fed?
Well, good question. And when Powell was asked that on Wednesday, he said, you know, that we really can't do anything about it. That's for the political poobahs and the fiscal authorities to fight over. Of course, what the Fed never wants to admit is that if the Fed had not long ago gone out in this direction of being willing to monetize all of these deficits and debt, we wouldn't have got to this place. So the Fed, you know, as much as it wants to remain agnostic and say, well, this isn't our doing, they're the enabler. You know, once upon a time, at least during the first part of his tenure, before he became what Arthur Burns and everybody since has been, Paul Volcker at least would not enable that big deficit spending the first couple of years when he was on the job until he flipped. So in that earlier manifestation of Volcker, that's why interest rates shot up to the moon for that brief period of time. It's because the Fed was not going to enable higher deficits. And of course, we look back on it and you have to chuckle these outlandish deficits that Volcker was not going to tolerate, and where the U.S. Treasury to fund these deficits had to get money from Japan and private investors, and in those days more so Germany and some other ones. They had to pay 15, 18% for that money. They didn't have the Fed just printing it and saying, okay, we'll buy it. And the level of those outlandish deficits back then was 30-40 billion dollars. We're going to have a $2 trillion deficit this year.
Well, what's a few $1 billion between friends, right?
So the Fed, and here again, their fallback position, whether it's over the debt ceiling or whether it is over, economy and the banking system and whatnot, is they tolerate this as, again, a means to an end, to get froth out of the market, to get speculation out of the market, to bring economic activity down and hopefully inflation with it. They tolerate it for as long as the system functions. Okay, when they can no longer tolerate it is when some kind of crisis comes and all of a sudden things are seizing up. When XYZ company's $100 a share and you're trying to get out at any price, and there isn't any price because there's no bids. Same thing for any kind of paper in the bond market, commercial paper market, and things like that. When transactions aren't getting done at any price, even with somebody trying to sell, taking a haircut just to get out, that's when they can't stand by anymore. But again, we're not at that point. And even with these stresses that we've seen with these handful of banks going bust and more to come, we've still seen the markets function. The cost of insuring against these has gone up. You look at the credit default swap markets, prices have spiked to buy insurance, even against treasury paper, because of this debt ceiling standoff, let alone you look at some of the shakier foreign debt. What hasn't happened yet is that corporate bonds in the US have still been far too complacent. I mean, they're not pricing a recession in at all.
No, they're not. And then on the geopolitical front, there's Iran being, Iran. They've seized a couple of oil tankers that were bound for the US in the last week. I guess there's a potential of that spilling into a problem again, and spiking energy costs, which energy costs go into everything. Could that be a factor into the Fed?
Well, it's possible, but you talk about spiking energy costs. That is nothing to do if it comes about because of some industry situation, or in this case, a geopolitical event. That's nothing to do directly, at least, with the Fed. And when you go back and look at it, Mike, this is the mistake that Arthur Burns made back in the 70s, when he later had to start raising interest rates more, but do it belatedly. He eased interest rate policy in part because of the Arab oil embargo, when inflation was going up because of the rise in prices. And look, the fact was that we were not, at least until that embargo and the political and strategic reasons behind it was solved, we weren't going to be getting any more oil at any price. So it was stupid for for Burns to ease monetary policy, because all he did is make whatever oil was already in the market, plus everything else, that much more expensive. And it's exactly the mistake that Powell already did make in that regard, when he eased monetary policy like no tomorrow, in the name of the pandemic, and because of disruptions in supply chains and supply shortages and things like that. Well, because of the pandemic and all of the things related to that, those goods weren't going to move whatever the Fed did. The fact that there were shortages of these things had zero to do with the Fed. But this nitwit went ahead with the idea that he was going to help save everybody, and the markets to boot, of course, and just made everything more expensive that was changing hands by printing all this money. So he's already done that, and it would be idiotic to do it again if you saw it. And frankly, I think this time around he wouldn't, because if oil does rebound again and that starts to add to the inflation equation. I think that as long as the markets are still functioning, he probably would look at that this time around as a reason and a bias toward tightening further than they're going to do otherwise if oil popped up. But again, we wouldn't be in this mess if it wasn't for him having gone the other way and channeling Arthur Burns, from roughly the 2019 into 2020, when he really stepped on the gas, and for another nearly 2 years after that.
Yeah, well, as to say, we live in interesting times, don't we?
Yep, sure do.
If people want to get your viewpoints on the world, how do they get a hold of you?
Just go to nationalinvestor.com. There's a smattering of some semi-recent commentaries and things on there. We're going to be augmenting that in the not too distant future with some newer stuff. But you always get my new stuff if you sign up at the very least for my free newsletter. And there's a tab that you'll see on the website for that right away. So nationalinvestor.com.
Wonderful. Thanks very much for joining me, Chris, and I look forward to having you back on soon.
All right, take care and have a great time in New York. My regrets that I can't be there with all of you, but I know it's going to be a great conference. There's a hell of a lineup there.
Yes, there is. And if our listeners are in the New York area next week, that's the week of the 8th to the 11th, the New York chapter of the SME is putting on a hell of a show, and you could go and learn an awful lot about investing in the mining sector by being there. So not an investor conference, so you're not going to hear companies, pitching their projects, but it's a general good overview of the macro and some of the minutia of what it takes to, take a project to become a mine. So as I say, if you're in the New York area, be worthwhile to check out. Again,
Good
thanks
stuff.
very much for joining me, Chris.
Take care.
The Prospector News Podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.